The U.S. housing market is experiencing an affordability crisis like never before, and some are calling this the biggest housing bubble in U.S. history. Well, dear viewer, I believe I've found the metal stake that's going to pop this bubble. And it's not macroeconomic voodoo or a black swan event emerging from China. It's actually something that can be utilized, be exploited today, right now, by US homebuyers in 2023 and 2024. And in this video, I'm showing you exactly what I found. Let's get into the data. According to the Case-Shiller Home Price Index, home prices in America grew a staggering, unsustainable 43% from the start of the pandemic to last year's June pricing peak. This price growth is indeed staggering, unprecedented. But is it correct to call it unsustainable? Mortgage rate hikes in the second half of 2022 caused a sharp tumble in pricing. But as of May 2023, the Case-Shiller has already regained almost all of its 2022 losses, posting a number just 1% below the all-time peak set last year. And the most recent data from Redfin confirms this rebound. As of July 30th, 2023, the median sale price of the US home was $380,250, just 0.7% off last year's all-time record of $382,861. But that's only half the story, because while home prices are up about 45% since before the pandemic, the true cost of owning a home, the mortgage payment, has doubled. And we calculate this by looking at each month's median home sale price, as reported by the National Association of Realtors, and each month's average rate on a 30-year fixed mortgage, according to the Freddie Mac Primary Market Mortgage Survey. Putting these two numbers together and assuming a 20% down payment, we see that the average mortgage payment on a median home was $1,031.74 in June 2020. By June 2023, that payment had grown by 105% to $2,119.72. That's the crisis. That the same home, the same median US home, costs twice today what it did 3 years ago. That the cost of owning a home in America doubled in just 3 years. That simply isn't sustainable, right? According to these village criers, the current US housing market is not sustainable, and all you have to do to achieve more affordable housing is wait. Just wait, and the long arc of the moral universe will bend toward justice and deliver unto you an affordable home of your dreams. And all their arguments break down to 4 basic ideas. 1. Macroeconomic conditions dictate that housing must crash. 2. Demand is going to fall off a cliff. 3. Supply is going to explode. Or 4. Affordability simply must revert to the mean. Pretty strong arguments. Let's explore. Firstly, the macroeconomic arguments. These guys, like former Radio Shack spokesman RJ Talks, make home price predictions based on the mortgage-backed securities market, the strength of the dollar against foreign currencies, and other macroeconomic factors.
The market's vastly underpricing the risk of tighter lending conditions, acting way overzealous with their hope for a change in monetary policy, pricing in Fed rate cuts much too soon.
And I'm not saying that these macroeconomic analyses are wrong, per se, but these are second or third order factors to consider when assessing the US housing market. Here's an example. Let's say the Dodgers are playing the Yankees, and you're trying to handicap the game, trying to figure out who's more likely to win. So you get a weather forecast for game day, then look back to see how each team performed in that kind of weather. Is this analysis irrelevant? No, but is it the best indicator, the most contributing factor to who's going to win? Hell no. You're much better off looking at the team's lineups, how the players have been performing, etc. And for the US housing market, that means looking at housing inventory and home buyer demand, not the strength of the dollar against the yen. Which brings us to argument 2. Demand is going to fall off a cliff, and without any home buyers, home prices will fall. In truth, you don't hear this argument much anymore because it's so patently counter to reality. I remember back in 2021 when Nick Gurley kept saying that home buyers are on strike.
Holy smokes, guys. The U.S. housing market is in dire straits right now here in July 2021. The crash has started and is getting worse. All the real-time indicators for the housing market, everything is pointing in a negative direction.
In reality, home buyers bought more homes in 2021 than at any time since 2006, which was the bubble of bubbles. Truth is, demand has already fallen off the cliff. The Mortgage Bankers Association publishes a weekly index of purchase applications. In other words, an index of how many people are applying for mortgages to buy homes. The index just came in at 154.1, which is lower than any reading we had during the Great Recession. Think about that. Fewer people want to buy a house right now than back in 2009 when the economy was in a massive recession and unemployment was at 10%. Actually, what I just said isn't quite true. To be precise, fewer people are applying for mortgages to buy a home today than as compared to 2009. But this isn't because fewer people want to buy a home. It's because fewer people can afford to buy a home. Demographically, there are way more people trying to enter the housing market today than in 2009. There are currently 72 million millennials, all hovering around the median first-time homebuyer age of 36 years, many of whom would buy a house today if they could afford it. Back in 2009, there were only 65 million Gen Xers in a similar age range. So the real demand story right now is pent-up demand. The real question is, how many sidelined homebuyers are ready to dive right back into the market when rates drop below 6%? How many would-be buyers are going to become buyers as soon as prices drop a few percentage points, thereby preventing any further price declines? Still, if nobody can afford to buy a house, why are home prices just 1% below the all-time high set during 2022's pre-mortgage rate hike feeding frenzy? Well, because there also aren't any homes for sale, relatively speaking. And this brings us to argument number 3. Inventory is going to spike, causing a massive plummet in prices. We've been hearing different variations of this same argument since the beginning of the pandemic. Wall Street firms were going to collapse and fire sale their inventory. Then mom and pop investors were going to fire sale their houses. Then new construction was going to flood the housing market. Remember all those real estate mindset videos of Travis huffing and puffing his way through under construction developments in Texas?
But you guys see what I'm saying? These price cuts are real price cuts. This is liquidation. If you guys are interested in potentially finding the deal of your dreams.
Well, Travis could have saved himself the aneurysms just by looking at the monthly data put out by the US Census Bureau's Survey of Construction. At peak, only 72,000 new construction homes have been completed and for sale since the start of the pandemic. This is the same amount of available new home inventory we saw pre-pandemic. So what's the story here? In fact, during the Great Recession, the highest that number got was 199,000. Again, think about that. When the bubble burst in 2007, existing home inventory climbed to 3.5 million homes. And then on top of that, you had your 199,000 new constructions home built and waiting for a buyer. So yes, the Great Recession obliterated home builders, but it was the existing home market that did the obliterating. So even if we got back to that Great Recession level of 200,000 new construction homes on the market, we won't see notable price declines until existing home inventory spikes. Existing home inventory is sitting just over 1 million units right now. In 2014 and 2015, we were seeing over 2 million units in the market this time of year. Inventory has slowly dwindled since before the pandemic to an unprecedented and sustained low. Cue the new Crash Bro supply side argument, the Airbnb bust, right? Airbnb hosts are making less profit, so they'll sell, flood the market with existing home inventory, and prices plummet. Maybe, but look, the last time Airbnb reported how many listings it has in the US, the number was 2.24 million, and that was down from the previous year's 2.31 million. Regardless, let's say Airbnb currently has 2.5 million listings around the US. And let's also assume, though we know it's not true, that each listing represents a standalone, independent home or condo. We would need 40% of all Airbnb listings to fail and then end up on the housing market to get back to our historical inventory norms. Is it possible that 40% of Airbnb listings across the country fail? It's not impossible, but if that's what you're waiting for, you might be waiting for a very, very long time. Of course, between now and then, the Crash Bros will probably parade out another half dozen supply-side red herrings to give you renewed hope that waiting for the bubble to burst is worth it. And finally, argument number 4. Affordability simply must revert to the norm. The argument goes like this. Historically, a median home costs 3 or 4 times the median household income. And right now, a median home costs 7 or 8 times the median household income. The ratio is out of whack. And just as all ratios revert to the norm, so shall this one. Well, sure, but by that logic, the days on market ratio also needs to revert to the norm. The number of homes on the market needs to revert. The demand from buyers needs to revert. Mortgage rates need to revert. In other words, for everything to go back to normal, you actually have to get everything back to normal. And how is that going to happen? And when? How soon? The Crash Bros have 1,000 specious answers. My answer is yes. Everything will revert to a norm. But based on demographics and the reality of our housing stock, that reversion's not coming until well into the 2030s. Eventually, baby boomer deaths will really pick up, creating a lot of new inventory, just as the pool of first-time homebuyers begins to dwindle. Of course, when that happens, the inventory coming to market will be mostly older, larger, less efficient homes in need of repair. An important question is, who's going to want those homes? Will a new industry emerge to turn these 5,000 square foot earth killers into environmentally efficient duplexes or triplexes that appeal to 2035's environmentally conscious buyers? Maybe. Everything will eventually revert to the norm, yes, but it's going to take a while, and that future norm probably won't look like the housing markets of 2017, 2018, 2019. Now, if you're watching real estate videos on YouTube because you think you might be buying a house in 2023 or 2024, don't get depressed. These guys are chumps. They don't want to help you achieve your dreams. They want to earn a quarter of a penny from your view. And negativity gets views. Fear is a more visceral emotion than hope, so pessimism sells. But I'm here to tell you that this housing bubble can be popped. 2020 pricing is achievable today, right now, in this housing market. You don't have to wait for a bunch of Airbnbers to fail or a bunch of boomers to die. You can achieve 2020 home prices by your own actions. Let me show you what I mean. As I mentioned, the mortgage payment on a median home in June 2020 was $1,013.74. That's because a median home, according to the National Association of Realtors, cost $294,500, and the average mortgage rate was 3.16%. Flash forward 3 years to June 2023. Now we have a median home price of $410,200, according to the National Association of Realtors, and an average mortgage rate of 6.71%. That creates a mortgage payment of $2,119.72. So the question is, how can we get a nice median US home with a mortgage payment around $1,000 instead of around $2,000? And here's the answer: buy a duplex. And no, I don't mean buy a townhouse or a house that's attached to another house. I mean find a duplex that's two homes that are attached or on the same property and buy the whole thing. You live in one side and the person living on the other side pays you rent to live there. And look, if you don't know that this is a thing, that you can buy a whole duplex and live on one side and collect rent from the other, then I'm the guy who's here to say, this is a thing. You can do this. You use the same realtor and lender you'd use to buy a regular house. You even buy the same homeowner's insurance. It's really no different than just buying a house, except for the numbers. Let me show you. Firstly, you'd be surprised by how inexpensive duplexes are. You'd think 2 homes, double the cost, right? Well, it's 2 homes, but it's still one property. In my experiences, duplexes cost maybe 10% more than a single family home nearby. For example, each unit in my duplex was about 1,600 square feet with 3 bedrooms and 2 bathrooms. And it cost about 10% more than a 1,600 square foot 3-bed, 2-bath home around the corner. So we'll say that our median duplex costs 10% more than our median home, or $451,220. And at a 6.71% mortgage rate, we're looking at a mortgage payment of $2,331.69. But that higher payment is going to be offset by the rent we collect from the other unit. So how much rent could be collected from the other unit? I'm going to say $1,600 per month. Why $1,600 per month? Well, if each unit collected $1,600 per month, and that's a safe assumption as most duplexes have mirrored units, then this duplex would have a gross rent multiplier of 11.75, which is totally within the norm. Now, I'm not going to explain gross rent multiplier in detail, though I will show you the equation while explaining that it's a simple metric that connects a rental building's price to the rent it collects. It's similar to cap rate, if you've heard that term, except it doesn't account for expenses. And 11.75 is totally commonplace. For example, this Columbus, Ohio duplex listed at $475,000 currently collects $1,500 from one unit and $1,950 from the other, which translates into a GRM of 11.5. All right, if I haven't lost you already, let's get back to our example median duplex with a purchase price of $451,000 and a mortgage payment of $2,331. When we subtract the rental income that we collect from the other unit, we end up with a net mortgage payment of $731.69. Holy shit, I overshot the mark. I was hoping to bring the mortgage payment down to $1,000 to June 2020 pricing, but a mortgage payment of $731 brings us all the way back to May 2015. That's rolling back the clock on 8 years of price growth. Talk about popping the bubble. Now, I know what you're thinking. Firstly, if a duplex costs 10% more than a house, then the down payment is going to be 10% more. It doesn't have to be. I'll do the math as I explain the basics. You don't have to put 20% down on a duplex. Put 15% down. Yes, you'll have to pay PMI, but PMI is very low on a 15% down purchase. And it's more than paid for by your rental income. In this example, if you put 15% down, you'll have a smaller down payment and your net mortgage payment is still just $1,032, right back at that June 2020 pricing as promised. And secondly, you're probably already aware that the math isn't quite so simple. $1,600 a month in rental income doesn't mean $1,600 a month in profit. You have to account for some vacancy, some maintenance. In some markets, landlords pay their tenants' water bill, etc. Well, more good news. Those details that seem kind of complicated really aren't. And to prove it, I made a web app that walks you through the numbers on a duplex so that you can figure out exactly how much one costs to own. The app is totally free and you can access it at www.duplexcalculator.com. You just set up an account, then start entering info on any duplex that you find on Redfin or Zillow or Realtor.com. I've pre-entered solid ballpark estimates for numbers you might not be familiar with, like maintenance and vacancy. And next to each line item is a question mark icon. Just click that for a full explanation of what the item is and how to get an even better estimate for your market. You'll see some links that say, need help finding a realtor? This is because I pay for the creation and maintenance of the Duplex Calculator through referral commissions. So if you need help finding a great agent to help you buy a duplex, just click those links. Once you've entered some basic info, the Duplex Calculator tells you what your monthly payment will be, factoring in everything. In these other tabs, you can also see what the cash flow looks like if you decide to keep the duplex as an investment property after you move out, how your equity in the property builds over time and how the equity breaks down, and an analysis of exactly how the duplex impacts your net worth over time. Subscribe for more no bullshit market analysis and smart as fuck home buying strategies.